This is John A.G. World. The globe is on edge, supply lines are broken, and the Middle East is at war. What you do something like this to define yourself. Do you read the room, or do you panic? Because you will lose if your psyche is not ready for situations like this. Not may lose, will lose, is the only way to express it. Furthermore, this has nothing to do with this or that conflict. Wars are only the mechanism. It's always the same narrative in reality. Millions of unprepared individuals are wiped off by markets, panic buyers and sellers on both sides, and a select class benefits generations from both. That's nothing new. In the world of finance, it is the oldest narrative. We provide data every day for this reason. Reports, figures, original sources, everything you want to understand the situation in a way that best suits your objectives. You are the only one who really understands your financial objectives. You are the only one who really understands your concerns. Determine your weaknesses. Talk to them. Be ruthless and impartial. You won't be saved by anybody. For a period. Be so ready that you become the person that others want to see. This channel is probably not for you if you can't suffer through 10 minutes of info every day to comprehend what's going on in the globe. It won't be. For my team and myself, it's a victory if even one person is able to earn enough money to pay their bills or buy food. Don't refer to me as a goat or a legend. Alternatively, don't even recognize me, if possible. Both my objectives and my victories are different. Referring back to my last video, patience remains the key. That is confirmed by everything that has arrived in the last 24 hours. The data from the vault drain, the image from Shanghai, Jane Street, oil, Iran, Venezuela, Poland, and the unemployment claims. Now let's get started. As I write this, silver is at the $82 Western spot. It struck $81.90 after dropping $84, and it is still consolidating. The shorter time spans lack clarity and are poor. I won't dress it up. I'll repeat it again. Just like I said yesterday. Right now, I wouldn't touch this. Complete halt. Adding leverage on top of it is a different issue that you are responsible for resolving. However, Shanghai futures finished at $96, Shanghai spot at $94, and the paper price at $82. That is a premium of $12. Let's start from scratch and construct the image. In a single session on Thursday, the Shanghai futures market lost an additional 22 metric tons of silver. In a single day, 710,000 ounces were removed from SHFE vaults. There are now 8,768,000 ounces of SHFE silver in stock. At $97.54, silver ended the day up over 2% on the HFE. At $5,192, gold closed on the same exchange. Platinum cost $2,543. At $1,929, palladium has marginally decreased. Silver is not priced the same in the Chinese market as it is in the West. There is no fault in that divergence. It's a signal. In addition, I paused mid-read when the Shanghai Gold Exchange released withdrawal figures for February. In 1 month, 115 metric tons of actual silver were removed. For February, the 8-year seasonal average is 62.5 tons, which is almost twice as much. Additionally, when January and February are combined, SGE withdrawals have reached 436 tons, which is more than twice as much as the same window last year, and a record high for that time in the whole dataset. Additionally, the SGE vaults lost 13,155 kilograms in only the week of February 23-27. That isn't a demand. It's a scramble. Cover that with COMEX. On Tuesday, 3 million ounces were emptied in a single session. Metal was concurrently removed from Asahi, Brinks, CNT, IDSD, and MTB, and hundreds of thousands more ounces were moved from registered status among 3 more custodians. There are now 87 million ounces of registered silver. Inventory as a whole is at a new 1-year low. Additionally, open interest in COMEX contracts has plummeted to 112,874, the lowest since 2013. The gamblers on paper are leaving. A casino loses its ability to establish the queue when its players leave. COMEX draining, SGE draining, and SHFE draining, all 3 at the same time, west and east. It's not a coincidence. Physical silver is fleeing the system at a pace that the paper price is unwilling to recognize, and that is a structural story. China's gold image now, as this expands on the same idea. Investment gold bars are now shown as sold out on the applications of the Agricultural Bank of China and ICBC, 2 of China's 4 major banks. They are no longer even available from the Bank of Communications. Retail stores in Beijing are charging more than 1,600 yuan per gram for branded gold. Similar to silver, the Chinese institutional and retail physical gold markets are displaying a stress signal. Supply cannot keep up with demand. Physical reality and paper prices are not the same. Although the price of paper gold in Western markets is around $5,096, the actual price of gold in Asia is different. Let's now discuss Jane Street. Discussed this in detail in the previous videos. If you haven't already, go watch it. There, everything is disassembled. What's new and what connects them is as follows. The equity value of the position has increased to over $1.6 billion. On top of that, however, there are $2.5 billion worth of call options on around 40 million underlying SLV shares. At $2.7 billion, place options on 43 million shares. More than 3 times the equity investment, or more than $5 billion, is in the options book alone. This company did not purchase SLV because it believed that silver would increase in value. The tool is the underlying situation. The money is made in the options book. This is why the pattern is important. As the price was climbing, implied volatility doubled from its October highs. Price increases should reduce anxiety rather than increase it. Profiting from volatility rather than direction, someone was accumulating significant options exposure before the move. Even as the price increased at this time, short interest increased. During the October crunch, borrowing rates reached 20%, although they remained exceptionally low. The number of shares that could be borrowed was many times that of October. Concurrently, there is an increase in price, a rise in short interest, a collapse in borrowing costs, and an explosion in implied volatility. A clean market does not have such mix. J.P. Morgan, the same company that settled 8 years of claims of spoofing precious metals in 2020 for $920 million, is the custodian of SLV throughout all of this. Resolved a federal lawsuit. Not a hypothesis. The fact that the structure remains the same is what counts now. It has just gotten bigger. Allow me to expand the frame now, because the macro forces acting on the same pressure point are rapidly building up while all of this is taking place in metals. Venezuela. A contract to import up to 1,000 kilograms of gold from Venezuela's state-owned mining business, Minervan, has been mediated by the Trump administration. Under a different government arrangement, Trafigura will transport the metal to U.S. refineries. The deal may be worth more than $150 million and requires 98% ultimate gold content, a single metric ton. The first ton is in motion. Here a pointed pattern is emerging. Metals are being diverted along political alignments rather than free markets, in a world that is breaking up into geopolitical trade blocs. A nation with tangible assets is exchanging tangible gold, which has been valuable for thousands of years, for paper money that will continue to depreciate. First, Venezuelan gold. And the experts who are keeping a close eye on this are already pointing out what will happen next. The strategic location of Mexican silver is the same. Silver may go in the same direction as gold if it follows political lines. Keep an eye on that area. Poland. As an alternative to the EU's loans for the weapons program, which have garnered criticism from the US, the governor of the National Bank of Poland suggested selling off a piece of Poland's 550-ton gold hoard, possibly producing some $13 billion to support defense expenditures. The Polish president was immediately presented with the proposition. This is not a certain result because of legal obstacles and the Prime Minister's support for the EU path. However, precious metals sold down as soon as it reached the wire. The market uses possible central bank supplies in this way. Whether that comes to pass is very uncertain. It indicates that the market is now susceptible to any supply signal and that you should size your position to take into consideration geopolitical shocks that are unrelated to fundamentals. As I write this, oil WTI is trading over $78, the highest level since January 2025, up around 35% to 40% from its December lows. This is where the energy situation becomes very hazardous. However, important regional energy infrastructure has already been targeted by Iranian troops in recent days, and top officials have openly said that $200 per barrel is the expected outcome if the battle intensifies. Approximately 20% of the world's oil consumption and LNG traffic still pass via the Strait of Hormuz. Calculate the inflation. The headline inflation rate in the Eurozone would rise by around 0.5 to 1%, even if the price of oil continued to rise to $108. It is not just an oil shock at $200. It is a specific, clear threat from an identified foe that has already shown a readiness to strike. While central banks have barely subdued the first large inflation wave, a second one is about to begin. On top of that, Qatar's LNG plant is now down due to strikes, with possible resumption occurring in the coming weeks. As markets shifted to fuel switching, coal futures shot up more than 8% in a single session, and Putin has openly suggested that Russian pipeline gas be immediately rerouted completely away from Europe. Coal substitutes, pipeline gas, LNG, and oil are all under pressure at the same time. Following a record sell-off, Korea's Chaos Pi saw a remarkable comeback today, rising 9.6%. However, the image changes as you zoom out. Today, the DAX is down 2.5%. The S&P is down, the Nasdaq is not up. The price of Bitcoin has dropped. Physical metals are depleting worldwide. Risk assets are selling down widely, and energy infrastructure is really in danger. At the moment, the market is not pricing optimism. Pricing stress is the cause. The data that was released today and its implications for your strategy. Initial U.S. unemployment claims were 213,000, compared to a forecast of 215,000, 1,868,000. Continuing claims compared to the 1,845,000 expectation. Initial claims were a little better than anticipated. Worse than anticipated going forward. The read-through happened right away. Paper metals moved down in response to a bid on the dollar. During the session, silver fell from 83 to 81.90. The mechanical correlation is that, with that amount, the physical market remained unchanged. The vault drain went on. There was no slowdown in the SGE withdrawal pace. However, the dollar was valued first in paper markets, followed by tangible reality. You are currently working in an environment where the SGE withdrawal rate was instantaneous. It's time for me to pause and discuss psychology. Straight lines are expected. They purchase silver at 80, anticipate 100, and get alarmed around 82. Your intellect is not judged by that retreat. It's sound. The market has never and will never move in a straight line. Then there's FOMO. Silver is priced between 80 and 86, and all those who missed it must now purchase at 86. No rationale for entrance. No way out. Just the urge to stay behind on an emotional level. They either freeze or add when the inevitable slowdown occurs. Both are incorrect. Both are feelings, not judgments. The most expensive one. Those who believe that a thesis is a strategy. The rising price of silver is not a transaction. A trade has a time horizon, a size you can sleep with, an entrance, an exit if it is incorrect, and an exit if it is correct. You are not trading if you do not have all 5 specified before you begin. You're responding. And as soon as you are in the role, this market will discover it. The short-term tape is poor at the moment. There are bids on the dollar. Non-farm payrolls are due tomorrow. Strong influence, dollar correlated, and able to cause metals to move drastically either way. Silver's smaller time periods don't provide a clear read. Expect more short-term bearish pressure on paper metals if DXY closes above the level I've been monitoring since January 15th and receives follow-through on NFP. The situation shifts if it is unable to maintain that level. The binary is that. In any case, the key is patience. The case of the honest bear now. Silver retreated from 84. A supply indication that the market is taking seriously is Poland's plan. Dollar strength based on non-catastrophic facts. Paper open interest is at its lowest level in 10 years. This might be due to structural participation departing or weak hands flushing. Furthermore, regardless of the fundamentals, everything sells during a true liquidity event. These are actual dangers. Include them in the sizing. However, none of it alters the actions of the actual market. In a single session, 22 metric tons of SHFE were extracted. In 2 months, 436 tons were removed from SGE. A document, on Tuesday, 3 million ounces were simultaneously removed from COMEX by 6 custodians. The biggest bank in China ran out of actual gold. The Shanghai premium of $13 persisted throughout the paper sell-off. Those aren't views, check them out for yourself. Tomorrow, watch NFP. Keep an eye on whether DXY closes above or below the level from January 15th. On paper, they are the 2 factors that determine the short-term course. The long-term indication is the physical drain. I'm leaving one question unanswered. Does the physical drain rate increase if NFP raises the dollar and puts additional pressure on paper metals? Because it is the situation that makes this gap unavoidable. Invest sensibly rather than irrationally.